In this episode, we share end of year tax planning tips that could benefit you financially. Let's get started.
Let's get some money. From New Money, New Problems, it's the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Negotiating compensation, purchasing your first investment property, helping your family with money, the highs and lows of entrepreneurship. New money brings new problems that require new solutions. Join us as we work through them together. I'm Brenton Harrison, and this is the New Money, New Problems podcast.
Hello, and welcome to this week's episode. This is one where we're going back into teaching mode. We've had some episodes recently where we've had some resources that we've shared. There's some really cool interviews that we have coming up over the next several weeks. But right now, I wanted to go back into the mode of, hey, here's something that I think is beneficial. I want to walk you through some of the things and some of the ways that you can utilize this information. And I'll tell you that we're going to be doing this framework of how do we benefit ourselves financially when it comes to our taxes before the end of the year, but it's going to be through the lens of an employee, a W-2 employee. However, we are going to record an episode on our private podcast channel that if you are interested in subscribing to, you can get that information at newmoneynewproblems.com/subscribe. That episode is going to be just for business owners. So if you're a business owner and you feel left out of this conversation, don't worry. Make sure that you have the RSS feed to the private podcast, and we're going to release that sometime in the coming days. With that said, the reason I think that the timing of this episode is crucial is because when you get to the end of the year, it's like this duality of trying to make sure that you have a plan for the year ahead when it comes to taxes and having that proactive plan that you're looking forward to using and informing your financial decisions, but also trying to make sure that with the last month and a half or so that we have, that you take advantage of any last minute opportunities that you can to reduce the taxes that you may owe, if that's the goal, or at least to optimize your finances with taxes in mind. And with that in mind, we're going to share some tips that we hope will allow you to do just that. And we're going to start with, instead of a tip, identifying to me what is the most consistent reason that people end up with unexpected tax bills when you're going into the tax season, and that is under withholding. Now, withholding is literally what it sounds like. When you fill out a W-4 for your employer, they ask you all types of information about the makeup of your household. Are you single? Are you married? Do you file married filing separately, married filing jointly? How many children do you have? How many dependents? So you can set your allowances. And based on that information, they estimate how much they think you'll owe in taxes, and they withhold that amount from your paycheck throughout the year. Now, when I look, especially for high income earners, and they get an unexpected tax bill and they're upset with their tax preparer, it often comes back to under withholding. And when you look through how they filled out their W-4 as compared to the structure of their income, it makes a lot of sense. For example, just last week, we had a meeting with a very, very high income earner who was earning well into the levels that would have the highest portion of their income taxed at either 35 or 37%. But this person also had several children, several allowances. They were married, so they filed married filing jointly. So when they filled out that W-4, it makes it look like they shouldn't be paying that much in taxes. They have all of these factors that would reduce the amount that they pay on the income that they earn. And if you looked at what was actually being withheld from their paycheck, it was around 20% or so. So if you're thinking about it, if they're having huge portions of their income taxed at 24, 32, 35, 37%, but they have about 20% being withheld from each dollar of their check, that alone, just from their regular salary, was going to lead to significant under withholding and a significant tax bill that they may be unaware of. But let's assume that the highest portion of your income is taxed at the 24, 32, 35, 37% brackets, and you somehow had the wherewithal to fill out your withholding appropriately, and they're withholding the proper percentages on your day-to-day salary or hourly rate. Well, that doesn't take into consideration what you receive in bonus pay, because in most cases, the standard withholding for bonuses is 22%. So even if a W-4 is filled out correctly and you have higher portions withheld from your paycheck, if your tax rate is higher than 22%, but you have a bonus that's withholding 22%, you could still be in trouble. The same is true if you have equity compensation like restricted stock, where the shares that you are granted, even if you're not receiving them in cash, are taxed to you as income based on the value of the stock when it vests. As an example, let's say that you have 1,000 shares of restricted stock in your company that vests in the last quarter of this year. And on the date that it vests, the share of that stock is worth $50 per share. Well, that means that even though you didn't receive that income in cash from a tax perspective, it looks like you earned $50,000. And at a standard withholding of 22%, the withholding on that bonus would be $11,000. So you may sell enough shares to cover the estimated $11,000 at 22%. But if the highest portion of your income is taxed at 32%, you should have withheld $16,000. And just that one quarters of vesting could lead to an underpayment of $5,000 in taxes and an unexpected tax bill. Now, you may be asking the question when you hear all this, well, how do I know if I've had underwithholding? How do I fix this? One of the quickest ways that I've found is to look at your most recent pay stub. And in that pay stub, it's going to show you your pay before taxes, and it's going to show you your pay after taxes, and it will show you the amount of federal, state, and local taxes that were withheld from that paycheck. For bonuses, you can look at the pay stub from that bonus, or you can reach out to your finance or HR department and ask them the rate of withholding that you currently have set on your bonuses. And if you have restricted stock and equity compensation, either between your employer or the custodian that holds those shares of restricted stock, you should be able to ask them your current elections on how much is being withheld to cover those estimated taxes. And if by the end of the year you need to catch up, you can correct those withholdings by asking more to be taken out of your paycheck before the year end. And even moving forward, we often find that for really high income earners, they need a tax preparer to walk them through how they should fill out their W-4. Because even if you're married, filing jointly, and have a bunch of kids, based on your income, it may be more appropriate moving forward to possibly change your marital status on your W-4 to single and to possibly reduce your allowances even though you have more children than you're claiming, which doesn't mean you have less children. It doesn't mean that you're currently not married in the eyes of the IRS. It's just filling out your W-4 so that when they're estimating how much should be withheld, you're increasing the amount that they use when they're looking at your paycheck. Now, this next thing to be aware of is something that if you are in a position where you did have underwithholding, you could potentially use this tip to help solve that need, but you could also use it to benefit other areas of your finances, and that is utilizing the Social Security bonus. This is something that I say in jest. It's a term we use in the financial services industry. It's not a real thing where you get like an extra bonus for Social Security, but what it refers to is we've talked about Social Security on this podcast in the past, and that you pay as an employee 6.2% in Social Security taxes and 1.45% in Medicare taxes. Now, you owe that 1.45% in Medicare taxes on all of your income. Matter of fact, when you earn certain amounts of money, you pay more than that. You pay a Medicare surcharge on top of that 1.45%. But that base level of Medicare taxes, there's no limit on how much you earn and how much is taxed for that type of tax. However, with Social Security, it works differently. Social Security is 6.2%, but it's only levied against income up to the Social Security wage base. The wage base in 2025 is $176,100, and that means that for someone who earns $500,000, they're paying the same amount in Social Security tax as the person who makes $176,100. It doesn't matter that they make more than twice as much. Everybody stops paying their Social Security tax once they have met that wage base. Now, if you are an extreme high income earner and you earn more than $176,100, what that means is throughout the entire year before you hit that wage limit, you have the Social Security taxes coming out of your check. But once you cross over that threshold, that 6.2% drops off. And that's what's called the Social Security bonus. It's the additional 6.2% that's on your check after you've paid all the taxes to Social Security that are required for the year. This represents a golden opportunity for people who have under withheld on their federal income taxes to take that Social Security bonus and put it towards their withholding for the rest of the year to make sure that their tax bill is reduced. But if you're not in a position where you've under withheld, then you can put that extra Social Security bonus towards other things, like potentially maxing out a health savings account or a 401k or anything that can help lower your tax bill even further before year end. To illustrate this, let's use an example of someone who in the last 2 months of the year is getting a Social Security bonus. They've paid all that they owed from January through October, and in November and December, they get a 6.2% bump in their pay. Now, this is a rough calculation, but by my phone math, in order for someone to be in this situation, they would need to earn about $210,000 a year or so. That is $17,500 per month, and 6.2% of it, that Social Security tax that they no longer have to pay in November and December, is $1,085 a month. That means that over the next 2 months, if they have taxes on other portions of their income that weren't paid, they could put it towards those items. But it also means there's an opportunity to repurpose those funds into things like an additional 401k contribution that not only lowers your taxable income and your taxes even further, it also bumps the amount that you're investing towards your own future with additional funds that you have at your disposal at the end of the year. Along those same lines of retirement contributions, you want to have an idea when it comes to not only your investments, but your employee benefits of things that are calendar year deadlines versus things that are tax or plan year deadlines. An example would be a 401k or a 403b. If you're putting contributions into your 401k and 403b, anything that you want coded in the 2025 tax year has to be contributed before the end of 2025. It is a calendar year contribution deadline. Conversely, if you wanted to put money into an individual retirement account and have it coded as a 2025 contribution, you can contribute those funds all the way up until the tax deadline of the following year, meaning that you could have a contribution to your IRA on April 14th that is actually coded as a 2025 contribution if you so choose. It is a tax year deadline. Health savings accounts, flex spending accounts, dependent flex spending accounts. These are other examples of employee benefits where, from a contribution perspective, it is a calendar year deadline. But those are from contributions. What about these employee benefits where you can make distributions that are eligible for reimbursement? You'll remember that a health savings account is an account where the funds that are not used roll over from year to year. There is not much concern about you ending the year with money in your HSA that has not been used. Matter of fact, some people never use the funds in their HSA because they plan to use it as a secondary retirement account. However, with flex spending accounts and dependent flex spending accounts, those are use it or lose it plans. If you don't use the funds, there is the possibility that it reverts back to your employer. With a dependent flex spending account, the contribution is a calendar year deadline. If you are trying to distribute it for reimbursement, it may be a calendar year deadline, or your employer may offer an allowance that extends a few months into the next year. And the same is true with your flex spending account. It may be that your plan has a calendar year deadline where if you want to use those funds before they revert back to the plan, you have to do so before December 31st ends. But you will also find that many employers will offer an allowance up to March 15th of the following year to have a withdrawal from that FSA credited for reimbursement in the year prior. Next up, we're going to talk about bunching charitable contributions. If you haven't listened to it, a couple months back, we did an episode on can you give too much to charity? And in that episode, we talked about some of the changes to charitable giving in the One Big Beautiful Bill Act. Prior to that act, the way that it would work with charitable giving is you can only take a tax deduction for charitable giving if you itemized your taxes. So there are people out there who are charitably inclined, but because they filed for the standard deduction, they didn't get any tax benefit from doing so. And there are also people who are charitably inclined, but because they itemized their taxes, they would put some real strategy behind when and how they gave. So I'm going to give you an example of both camps and how the new One Big Beautiful Bill Act could impact them positively or negatively. Let's start with people who typically take the standard deduction but are charitably inclined. If I were charitably inclined but filed for the standard tax deduction, I would not be giving any money in the end of 2025 that I could conceivably give at the beginning of 2026. The reason for that is, as a part of the One Big Beautiful Bill Act, even people who file the standard deduction can take up to $2,000 of deductions for charitable giving. So if you, as an example, file for the standard deduction and you gave $500 to a charity at the end of 2025, you get no tax benefit for doing so. It's not an itemized deduction. But starting in 2026, that same $500 would potentially be a tax deduction based on your income level that you can now take advantage of. That's an example of someone as a standard filer who would benefit in waiting until 2026 to charitably give. Now let's give an example of somebody in 2025 who would benefit from giving now money that they may plan to give next year. The reason it would benefit someone who itemizes is moving forward in 2026 and beyond. Instead of being able to deduct charitable contributions from the first dollar that you give, there will now be a 0.5% floor that you have to clear before you can deduct any of your charitable giving. If we have a person who has a $100,000 adjusted gross income and the $500 is the only amount that they gave to charity for the year, they would not be able to deduct a dollar of that contribution because the 0.5% floor would say that they have to give more than $500 before any of it is deductible. So if they gave $600, they would only be able to deduct $100 of it. 600 minus the $500 floor based on their adjusted gross income. So if I were in that camp and I had money that I planned to give in 2026, I would consider giving it in 2025 instead. And this is also true for people who are at extremely high levels of taxable income. Because going back to those tax brackets, the tax brackets go up to 37%. So you would hope for someone whose highest levels of income is taxed at that amount, that if they gave a charitable contribution, they would be saving that 37 cents on the dollar based on that rate. However, as a result of that One Big Beautiful Bill Act, it doesn't matter if your tax rate is 37%. They are capping the amount that you can benefit from the tax deduction at 35%. Now, if 2% doesn't seem like that big of a deal, I can tell you if you're in the 37% tax bracket, every single percent and every tax deduction is crucial. So this is an example or two examples of people who might front load their giving in 2025 as compared to waiting for the next calendar year. Another option for people who are charitably inclined is before the end of the year to consider giving appreciated gifts or property. And when you do this, not only do you receive a tax deduction, you also avoid paying the capital gains tax on that appreciation. So say we have a person who has $5,000 of stock that they purchased that grew to $12,000. So there's $7,000 of gain in that stock. Well, if they were planning to give $12,000 to a charity, I know this is a very charitable person, but just go with me for calculation's sake, they would have to pay capital gains tax on that 7,000 of growth. Conversely, if they take that $12,000 and instead of ever selling the stock, they donate it to a charity, they get a tax deduction for that $12,000 donation. And now the charity takes the stock and sells it on their end, which means that you, as the donor, avoid paying that capital gains tax because you did not realize the gain. You donated property that had appreciated, the nonprofit sold it, and nonprofits don't pay capital gains tax. So this is yet another way before the end of the year, if you're trying to maximize your deductions while also avoiding taxes, to marry your investment strategy, your charitable strategy, and your tax strategy to the benefit of your finances. Next up, filling up your lower tax brackets. And this is all about looking at what your future income may be. And if you have the opportunity to essentially realize some income at a lower rate, taking that opportunity to do so. Let me show you an example. We've used some really high income earning examples, so we're going to go to a different tax bracket and we're going to assume that we have a couple that's married filing jointly and they are in the 12% tax bracket. That just means that the highest portion of their income is taxed at 12%, and their taxable income for the year right now, before they make any moves, is $75,000. Well, if you're looking at the tax brackets in front of you, you'll see that they're towards the top part of that 12% tax bracket. And as long as they don't run over $96,950, they will stay in that 12%. But if they go even a dollar over, that next dollar will be taxed instead of at 12% at 22%. It's a 10% jump, which is a major jump, but 12% is a pretty low tax rate. So let's say that this couple has things like pre-tax retirement accounts at their job or in an IRA, and they've been wanting to convert that pre-tax account into a Roth account. And when you do that, anything that you convert is considered income. So if they were to convert $10,000 from their pre-tax IRA to their Roth IRA, it would look like they earned 10,000 more dollars, and it would take that taxable income from 75,000 up to 85,000. The good thing is that's still in the 12% tax bracket. Let's also say that this person has some stock options at their job. They just started a new job. It's at a tech startup and they have these non-qualified stock options. But if they exercise these options, it will also be considered income for a portion of that exercise. Well, if they're already at 85,000, they can go up to another $11,950 before they bump into that next highest tax bracket. So this is an opportunity to what we call fill up the brackets. When you're at a lower tax bracket, taking advantage of some things that you can do that can benefit you in the long term financially, all within the boundary of that bracket before bumping into a higher one. These are the types of things that when you do it in conjunction with a tax professional or a financial advisor, can have real long-term dividends based on moves that you made in the here and now. Now, all of this is to say, and the reason I finished with that one, it was saying in conjunction with a tax professional, a financial advisor, is because the biggest tip when it comes to end of year planning is to reach out to a tax professional now. I have shared that the majority of really competent, really strong CPAs, EAs with whom we work, they are busy to the point that they close their books to new filing clients typically before mid-January of the following year. And some are so busy that they close themselves to new filing clients before the current calendar year even ends. I am not a fan of high income earners filing their tax returns. There's too many things you can get wrong, too many things you may not take advantage of because you are simply unaware. To me, if you're someone who says, oh, my return is so simple, well, then you wouldn't pay that much to a tax preparer because you typically pay based on complexity. And if your return is so complex that you're worried about how much you should pay, then you are the perfect person to be sitting in front of a professional to make sure you don't screw that return up by trying to self-prepare. So my last tip is to take this opportunity to hopefully realize all of the complex things I just said and say to yourself, I can't do this on my own. I need to reach out to someone who can help me and file this on my behalf. And if you've come to that realization, I strongly encourage you to make that introduction sooner rather than later. I'll see you next week.
From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.